Welcome to Iron Financial. This is the explainer, where we skip the fluff, grab the sledgehammer, and tear corporate earnings down to the absolute studs. Our mission here is singular. We want to help you cut through the market weakness, ignore the noise, and forge a stronger, much more durable portfolio. I'm your lead analyst, and as always, I'm joined by our resident market skeptic. Today, we are executing a ruthless, no-nonsense teardown of AMD's May 5th, 2026 Q1 earnings report. We're going to dig deep into the top-line revenue, we're going to scrutinize the debt, rip apart the margins, and find out if this company has poured a solid concrete foundation for the coming decade, or if the whole structure is just a house of cards about to cave in on itself. So, grab your hard hats, let's dive right into this. Look, I'll be the one to say it right out of the gate. According to the data we are seeing across the market, and honestly, including a lot of the recent coverage highlighting this very point, AMD's stock has been on an absolute tear. It surged 63% over the past month alone as bullish sentiment for artificial intelligence completely recovered. Think about that for a second, 63% in a single month. As an investor, my immediate instinct is pure self-preservation. I really want to know if this massive, towering structure of evaluation is actually built on solid steel, or if we're just looking at a mirage made entirely of speculative AI dust. We have to ask, is this an unbreakable foundation, or are retail investors walking straight into a trap that is priced for absolute perfection? Because if it's priced for perfection, any slight breeze knocks the whole thing over. That is the exact right question to ask. And to answer it, we really have to look at the blueprint handed to us by the chief architect herself. Dr. Lisa Su, AMD's chair and CEO, stated in the official press release, and I quote, "We're seeing strong momentum as inferencing and agentic AI drive increasing demand for high-performance CPUs and accelerators." What she's doing there is pointing directly to a massive structural shift toward heavy-duty AI infrastructure. But talk is incredibly cheap in this market. I mean, every tech CEO out there has AI stamped all over their earnings transcripts right now just to juice their multiples. I honestly don't care about the conceptual blueprint. I want to inspect the actual physical load-bearing pillars behind these words. You have to show me the execution or show me the door. Because hype absolutely does not pay dividends, and retail investors need way more than just optimistic architecture to build real wealth. Fair enough. Let's bring out the heavy equipment and inspect the raw materials. Q1 2026 revenue came in at an absolutely staggering $10.3 billion. Now, let's put that into perspective. That is a massive 38% year-over-year increase. In any macroeconomic environment, bolting on 38% growth at this sheer scale is a testament to some incredibly heavy lifting. It's one thing for a small startup to double their revenue, but you don't just stumble into $10 billion in a single quarter without having products that the biggest enterprise players absolutely have to buy right now. This isn't just a marginal earnings beat. This is a company rapidly expanding its footprint and capturing real, tangible capital from the market. The steel is in the ground, and it is holding up incredibly well under pressure. But listen, revenue is just the top floor. We really need to head down to the basement and inspect the cash. AMD generated a record $3.0 billion in cash from operating activities. And even more importantly, they posted a record $2.6 billion in free cash flow for the quarter. Let me tell you, this is the liquid concrete pouring directly into AMD's foundation. And let's be crystal clear about why this specific metric is entirely non-negotiable right now. In a high-interest rate macroeconomic environment where borrowing costs are absolutely crushing highly leveraged tech companies, having $2.6 billion in free cash flow is an impenetrable shield. It ensures long-term durability, it gives them the capital to service existing debt without breaking a sweat, and most importantly, it fuels the massive future R&D needed to keep up in the relentless AI arms race. Okay, I have to admit, $2.6 billion in free cash flow is an incredibly strong reinforced pillar. You really can't fake cash in the bank. It means they aren't just selling, they're actually collecting. But before we go ahead and declare the structure earthquake-proof, we really need to stress test the actual profitability metrics. Because when I look closely at the reconciliation tables, I see two very different stories being told. Yeah, let's talk about margins, specifically the gap between what standard accounting rules say and what management wants us to focus on. Notice the GAAP gross margin sitting at 53% right here, but the non-GAAP gross margin, which is the adjusted number they like to highlight, is sitting up at 55%. Now that 2% delta might look really small on the surface, but at a $10 billion revenue scale, that is literally hundreds of millions of dollars being shifted around. I want to know what structural cracks are being patched over with accounting spackle here. Because when you dig into the bar chart data, you see massive adjustments. We are talking $261 million in amortization of acquisition-related intangibles buried just in the cost of sales. And it gets even more pronounced when you look at operating income. So GAAP operating income was $1.5 billion, which represents a 14% margin. But non-GAAP operating income, that was reported at $2.5 billion, hitting a 25% margin. That is a full $1 billion delta.
Exactly. And where on earth is that $1 billion going? I'm looking right at the reconciliation data here. $479 million in stock-based compensation, sitting right there in the operating expenses. Plus another $290 million in amortization of intangibles. That's real actual dilution for the retail investor who is effectively paying for executives to hit their vested targets. Plus, AMD is using a projected non-GAAP normalized tax rate of 13% for fiscal 2026. As an investor trying to forge a strong portfolio, you have to ask what this actually means for your wallet. Are we buying a company fundamentally making $2.5 billion or a company making $1.5 billion? It's a critical distinction, and you are absolutely right to drill down on it. But to understand why the broader market is paying a massive premium regardless of that accounting gap, we need to locate exactly where this revenue is originating. We need to isolate the true engine powering this entire machine.
Beginning in the first quarter of fiscal year 2025, AMD strategically combined the client and gaming segments into one reportable unit to better align with how they actually manage the business structurally. So now we have a very clear picture of the two main towers of this company. In Q1 2026, that combined client and gaming segment pulled in $3.6 billion. But pivot your attention over to the data center. It brought in a staggering $5.8 billion. The legacy business is actively being dwarfed by the massive structural expansion of the data center segment. This brilliantly illustrates the shift in their entire business model. Let's examine the official Q1 summary blueprint straight from management. The numbers are literally night and day. Yes, client and gaming grew 23% year over year to hit that $3.6 billion. That's fine. It's solid drywall. But the data center revenue, $5.8 billion, up an explosive 57% year over year. The entire narrative, the entire 63% stock run up over the last 30 days, the entire future of this stock is riding almost exclusively on these server racks. If the data center shows even a hairline crack, the whole building comes down. But right now, there are absolutely no cracks in that specific pillar. Just observe the sheer velocity of the server growth. Q1 2025 data center revenue was $3.7 billion. Now, exactly 1 year later, it's $5.8 billion. This 57% spike isn't just a temporary surge or some one-off accounting trick. It is a permanent reinforcement of AMD's market position driven by intense, heavy-duty demand for their EPYC processors and AMD Instinct GPUs. This right here is where the heavy lifting of the AI revolution is actually happening. Section 1. The OpenAI Blueprint, Forging the Future. This brings us to what is arguably the most critical structural development detailed in this report. Let's break down the massive scale of this OpenAI deal, because the terminology being used here is usually reserved for literal power plants, not silicon chips. Back in October 2025, AMD entered into a product purchase agreement with OpenAI to deploy a mind-boggling 6 gigawatts of AMD GPUs. Think about that amount of power. They are currently starting the deployment of the first gigawatt of capacity powered specifically by the AMD Instinct MI450 series products. This isn't just a standard purchase order. This is the solid steel rebar in AMD's long-term investment thesis. It locks in massive, guaranteed, high-margin demand from the undisputed biggest player in the AI space. Okay, I hear you. A 6 gigawatt deal sounds incredible on paper. But as the skeptic, my job is to look for execution risk. And man, this is where the red flags pop up all over the site. Supplying a single gigawatt of AI processing power is a monumental manufacturing and logistical hurdle. Can AMD actually scale the physical supply of these MI450 series chips fast enough to meet this blistering AI demand? We've seen supply chains fracture under far less pressure than this. Between TSMC fab capacity, advanced packaging bottlenecks, and high bandwidth memory constraints, execution is an absolute tightrope walk right now. Having the blueprint for a massive skyscraper is great, but if you run out of cranes and steel halfway up, you've just got a useless half-built tower. Management expects customer forecasts to exceed initial expectations, sure, but execution is literally everything in this market. Section 2, Q2 2026 Outlook. Looking ahead. That execution risk is exactly why we have to look ahead at the forward-looking projections. We need to see if the company's scaffolding can actually support more weight in the coming months. For the second quarter of 2026, AMD is projecting revenue to hit approximately $11.2 billion, plus or minus $300 million. That midpoint represents year-over-year growth of about 46% and a sequential quarter-over-quarter increase of roughly 9% from the $10.3 billion they just printed. And this is where things get really tense for anyone buying the stock today. A projection of $11.2 billion is massive, no doubt. But when the stock has already run up 63% in 30 days, the market is expecting absolute flawlessness. Are these estimates sandbagged so management can easily beat them next quarter and look like heroes? Or is this stock completely priced for perfection? If they come in at $10.9 billion, the low end of that range, does the foundation crack and the stock absolutely plummet? To answer that, you really have to look at the profitability they are projecting on that $11.2 billion. AMD is forecasting their non-GAAP gross margin to tick up to approximately 56% in Q2. That is a sequential expansion, and it brilliantly illustrates that AMD has serious pricing power. Despite the massive costs of scaling up the MI450 production and dealing with incredibly high-performance components, their operational efficiency is actually getting stronger. They aren't just selling more volume, they are making a higher percentage of profit on every single beam they put in place. In the hardware world, maintaining or expanding margins while simultaneously scaling up a brand new, highly complex architecture is the ultimate sign of a fortified business. Section 3. The verdict? Opportunity or trap? All right, it's time to sweep away the dust, put down the blueprints, and look at the structures standing right in front of us. Let's synthesize the data for our final iron financial assessment on whether this stock is a durable addition to your portfolio or a high-price trap. On the bull side, you have a foundation made of ultra-high-strength concrete. We're talking $2.6 billion in free cash flow in a single quarter, an unprecedented 57% year-over-year growth in data center revenue, and locked-in long-term demand from OpenAI for 6 gigawatts of power. That is undeniable, immense fundamental strength. But on the bear side, you have the risk. You are paying a massive 63% stock premium based on a one-month run-up. You are dealing with a billion-dollar gap between GAAP and non-GAAP operating income, driven heavily by stock-based compensation and acquisitions. You are buying in at a point where flawless execution is the bare minimum expectation. Exactly. The foundation is undeniably unbreakable right now. The cash flow and the sheer data center dominance absolutely prove that. The question isn't whether AMD is a fundamentally strong company. It clearly is. It's whether there's any room left for retail investors to build wealth on top of it at these current valuation levels. So we leave you with this final provocative thought to forge your own strategy. Is that massive $11.2 billion Q2 projection just conservative concrete waiting to be easily surpassed, or have we already reached the absolute mathematical ceiling of this AI structure? Take a hard look at your portfolio, run the numbers, and decide if you want to pay premium prices for premium real estate. Thanks for joining us on this explainer. Until next time, keep building.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.